What is going on, everybody? Steve Parisi here. Hope your day's off to a great start. In this video, we are going to go through how to design a whole life insurance policy for maximum cash value. When it comes to whole life insurance, a common assumption is that I am purchasing a life insurance policy. If you've ever been presented whole life insurance, or perhaps you've owned it in the past, let me know if you've thought of it like this. I have a policy where I pay a premium, I have a death benefit. Typically that premium is very high. I view it as expensive. I'm told I have this great cash value benefit, but in the first year I have next to nothing. Or perhaps I have a percentage of my payment in cash value, but when I really look at the numbers, it takes me something like 10 years just to break even. Meaning if I've paid in $10,000 per year for 10 years, a total of $100,000, at that point in time, I have $100,000 and I'm in the red, negative, all the way up until year 10. This is why people typically do not like whole life insurance. And they say, okay, I hear these great things about it, that the wealthy put a lot of money here, it's safe, liquid, tax-free, but then I see an option and frankly, I'm not interested. Like I'm not going to waste my money or wait 10 years just to get it back. But then when it comes to a whole life insurance policy, here's the key on this. Did you know, here we go. Did you know that if you're paying any amount of money into a policy, you, the policyholder, can actually decide where your money goes? At the end of the day, your money can go toward one of two areas. I can direct my money toward the insurance premium or directly toward this PUA rider. Premium dollars, I like to refer to these as insurance expense dollars. Initially, if I pay any amount of money toward the premium with a traditional whole life insurance policy, say it's $1,000, I won't see anything show up in cash value, often in the first year, and sometimes the first and second year. And the main reason why is that premium dollars primarily purchase me life insurance first, and then cash value is secondary. In the first year, second year, nothing shows up in cash value. Beginning year 3, if you continue to make that $1,000 per year payment, I would see it come back to cash value. But a nice way to explain it from the insurance company's perspective is that they are going to overcharge you for the cost of insurance, the whole life death benefit up front. Whereas PUA, that stands for paid up additions, this rider, I like to refer to it as a cash dump-in. If I were to pay the same dollar amount here, $1,000, I would see that show up in cash value. That's money you can access right away. That begins to earn the guaranteed rate right away. It begins to earn dividends. This is the key to accelerating the cash value component of a whole life insurance policy. Now, it does buy you some additional death benefit as well, but just about everyone that we work with, when they are pumping money into this component right here, guess what they're interested in? The cash value. So many people express, I don't care about the death benefit. I'm interested in the cash value primarily. That is why I'm paying money into a whole life insurance policy. Reminds me of a story when I was in my early years in the business. When I first got into the business for a couple of years, I'm playing around with the design software. I'm sitting on the couch next to my dad, and he's always been into numbers, finance, investing. It's always been his thing. And he's looking at the numbers and he says, that's interesting. If I put money into this policy, can I just put nothing into the premium and put everything there into that PUA piece? Because he was interested in the cash value. And my answer was, well, Dad, we can't go quite that low. You have to put something in the premium. And my dad, being my dad at that point in time, said, I don't want to do it then. And about 10 years later, he purchased a policy. It might have been 8 years later, but my point is he was not interested at all in the death benefit. He was interested in the cash value component because with the whole life insurance policy, it is a safe, liquid, tax-free area to position money. I can also borrow against that policy and my money continues to compound as if the money were still there. But naturally, if I go back to the story about Dad, he wanted to pay nothing toward the premium. He has to pay something toward the premium. Here is the question right here that comes up. Following up, okay, I'd like to pay 0 here. If I can't go 0, how low can I go? And the answer to that question varies, depends really on the insurance company. You'll find with the top companies in the industry, your four major mutuals, a Mass Mutual, Guardian, New York Life, or Northwestern Mutual, who have always been just leaders in respect to crediting the strongest actual cash values to policyholders, you'll find that typically the lowest you can drive that premium is approximately 10%, which allows me to then allocate 90% toward the PUA component. So what that would mean to demonstrate, if you said, okay, I'd like to be able to pay $10,000 per year into a policy, but I do not want to get a bill for that. I don't care about the death benefit. I'm interested in cash value. How do I get the best possible cash value, assuming I make this $10,000 per year payment? And what you could do literally with the design is set it up where we have a $1,000 minimum premium. That would be your annual commitment. So you're billed for that each year. And then at your discretion, you can add up to another $9,000 per year into PUAs, totaling the $10,000. And to be very transparent, all companies have different limits. Some companies, if you have a $1,000 base premium, will allow you to pay another $10,000 into PUAs for a total of $11,000. Some smaller companies have no limits where you can go much lower than 10%. So it does depend on the company. But really to reiterate this story, how low can you go, does depend on the company. But what we found with the top companies, those four major mutuals, which have always credited the strongest cash values, when we drive the premium as low as we can, that's where we really set up that perfect storm where we have maximum cash value on a guaranteed and non-guaranteed basis. And looking at history and policies that have actually lived the test of time, we've seen this to be the case even more so. So that limit that I just referred to there, that 10/90 split 10% premium, would be an insurance company limit. So that's the first limit I need to be aware of. The second limit would be this guy, this MEC, which stands for Modified Endowment Contract. So a huge draw to cash value life insurance is in respect to the cash value. If you do everything properly, you can access that money tax-free anytime you want without penalty if you do everything properly. Don't you love it when people just say, if you do this, but I'm not going to tell you everything. So if your policy becomes classified as a MEC, a modified endowment contract, in the eyes of the IRS, what happens specifically is your cash value still grows tax deferred, your death benefit is still paid out 100% income tax free, but with a modified endowment contract, if you ever want to access the cash value, what will happen, to be very specific here, is in respect to the gains, one, you must pay ordinary income tax, and then second, if you touch it prior to the age of 59 and a half, we have an additional 10% penalty tax. And again, this is only on the gains, but still, it ruins a lot of the attractive features that come with a whole life insurance policy in respect to the cash value. So why I mention that is when it comes to a policy, every policy has what is called a MEC limit. And here's the fun part that I love so much. You, the policyholder, and your agent, when you first open the policy, can actually set that MEC limit wherever you'd like. To get technical for a moment, you'll find that that MEC limit has a direct relationship to an individual's age, gender, and the total amount of life insurance. So if someone said, hey, I'd like to have the ability to put in, say, that same $10,000 per year, we could set that MEC limit at $10,000. It might require a $200,000 or $300,000 death benefit. Again, depends on my age and gender. There's a couple other factors that go into it with the guaranteed rate a company offers, but it is a IRS limit that we want to set up appropriately when we first start that policy. So that's a quick demonstration in respect to how we design policies appropriately. If we were to look at a direct comparison, let's do that. We are going to look at a policy on a 35-year-old male paying in $20,000 per year, for 15 years, up until the age of 50. Now what's interesting about this example is we've got the same company, same product, same out-of-pocket payment, $20K per year, but a different design. So what is the impact to the consumer in this example? Here, first year, we see he pays in $20,000. This is an example with a 100% insurance expense. So this is a policy where I pay a premium, have a death benefit. I could view it as an expensive premium, and then eventually I see cash value build up over time. So there's the $20,000 payment. Right off the bat, about $700 in cash value. Going back to the whiteboard, if you pay money towards premium, what happens in the first year? Sometimes the first and second year, nothing shows up in cash value, or a very small amount in this example. Year 2, I pay in $20,000. I get just about all of that back. Starts coming back to work for me. But as I scroll down here, I see it takes about 12 years where I have paid in a total of $240,000, and I have $240,000. 12 years just to get my money back. This right here has been such a pain point for so many individuals in respect to whole life insurance, where they are interested in a policy because the cash value is safe, liquid, tax-free. That cash value is what they were sold on. That's why they want the policy. But then they see this and like, listen, I don't want to wait more than 10 years just to break even. There are so many other things I can do with my money in the meantime. Doesn't make sense for me. I'm not sold on it. So this is typically a big problem for individuals when it comes to whole life insurance, where it takes too long to get their money back. Maybe it's 7 years sometimes, whatever it might be. But let's transition to the example on the right, which is the same company, same out of pocket for the individual, $20,000 in the first year, and he's got about $16,500 right off the bat. The column on the far right represents the cash value difference, how much more he has in cash value with this option compared to this option. So what do we notice here? Right off the bat, you've got almost $16,000 more. Year 2, make the same $20,000 payment. I've paid in a total of $40,000. I've got $36,000. So $4,000 so far over 2 years has not showed up in cash value. What's highlighted in yellow here, year 5, represents my break-even point. There we go. Got $100,000 in cash value and almost $23,000 more in available cash value when I compare the two options, again with the same company, identical product, all of that good stuff. As I look at the years pass, what do I notice here? Well, if I look at the end of the funding period, year 15, you've got about $90,000 more in cash value. So from start to finish, you have greater value with the example with the minimum premium. Another thing that is a huge selling point, in my opinion, is the option on the right. My commitment, because the premium is minimized, is a little bit less than $2,000. And that's per year. I'm sorry, a little bit more than $2,000 per year. But that's my commitment, and I can add more money into the policy up to a total of $20,000 per year if I choose to do so. So I have a ton of flexibility there in the event life happens. I'm not committed to that $20,000 each year. And this is really what we have found to make or break a whole life insurance policy when it comes to the design. How do I design it for maximum cash value? Because when the cash value is maximized, that's when I am interested in moving money here. I've got a death benefit as well over time, which is fantastic. And I can access that cash value anytime I want to, or if I need, because it's there. And this type of design typically gives you greater value on a non-guaranteed basis. If we want to look at the guarantees, we see the same thing over time. Apples to apples comparison on a guaranteed basis. That example gives me more money as well. So I hope this video helped. I hope you enjoyed it. If you have any questions, please feel free to reach out anytime, and I'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.